Hi, I'm Danielle Fountain from the One Realty here in Austin, Texas, where we take a data-driven, all-in-one approach to real estate. So today we're going to talk about Home Buyers 101. Whether you're buying a home for the first time in Texas or the first time in general, this is a great basis to start with before you jump into the process. I really want to make sure that all of my clients not only have the knowledge when they go into it, but the knowledge to make the decision on the right decisions for when they purchase a house. So we're going to jump right into it and we'll go from there. So first, like I said, my name is Danielle Fountain. I'm the founder of the One Realty here in Austin, Texas. Let's see. Oops. And so with my, I say with my company, it's myself and my wife, Taylor Fountain. So a little bit about myself, just so you understand, is I went to the United States Air Force Academy for college, where we took numerous engineering and mathematical and business classes. From there, I went on to serve as an officer in the Air Force for 10 years, where I was a certified negotiator and mediator, and actually worked a lot with labor unions. So when we get into negotiations in real estate, I really enjoy that I have that background, both numbers and the negotiation aspects. My wife, Taylor, she went to Tarleton State University. She was formerly a general contractor, a roofing specialist, and she grew up on a ranch. So she has a lot of agricultural background from the farm and ranch side as well. And we live over in East Austin, and we have a son and 2 dogs. With that, a little bit about us. So our mission is to provide our clients with the highest level of service and professionalism of any real estate company, kind of with our all-in data-driven approach backed by the core values that I learned in the Air Force. So integrity first, service before self, and excellence in all that we do. Now, let's get into this. So first and foremost, thank you for joining us. And the biggest thing is congrats on taking your first step. If you are looking to buy a home, before you do anything, I would say you want to have a solid foundation understanding of what goes into the home buying process here in Texas. So we're going to talk a little bit about the buyer's roadmap. We're going to talk about the mortgage pre-approval process. We're going to look at your home search, what entails for the offer, the loan process, and the mortgage payments, kind of how that breaks down. The appraisals, do's and don'ts before you close, and finally, the final steps and closing day. That being said, the very first thing is to meet with a real estate professional or lender. So those are going to be 2 of the key people in the whole real estate transaction. Now, I don't necessarily, yes, I'm a real estate agent, I'm a realtor. At the same time, I don't look at myself as just that. I'm not just opening doors. I am your project manager. I'm your project manager from start to finish, from the beginning of this process, actually all the way through even home ownership. So if you have a question about it, that is what I am here to do. I'm here to bring you information and for you to make decisions based on data points. I am here to negotiate on your behalf. I'm here to find out and to provide local market knowledge, expert knowledge, with what is happening in the market. So we'll talk about later a macro and micro analysis of what is happening in the market. We will go through that whenever you are looking to make an offer, to make sure that you are making an offer that makes sense for both you and your long-term goals. I am also here to help with the stress management aspect. So rather than telling you a problem, I'm here to come to you with potential solutions or ways forward. And the other thing that I'm here to do is, yes, I'm your program manager. However, I'm also working with the agents and the agents on the opposite side. I'm working with your title company. I'm working with your lender. We're talking with inspectors. You might be having individuals out there to give quotes on things that you want to do to the house. I am building rapport with all of these individuals. And the reason is that if we work together as a team with some people, it's going to really help in the overall process. Now, that being said, one of the individuals that I work a lot with is going to be your lender. And your lender is incredibly important. You can go online, you can get a loan approval or a pre-approval from so many different places, but it's really important that, number one, you choose someone that has a trustworthy reputation. You are going to have to work with them. The title company is working with them. So is the agent on the other side, in a sense, because you have to make sure that you can get to closing. So we want to make sure that whatever lender you select, they have the ability to execute and to get you closed on time, so you're not in default. If they can't close you on time, there is a chance that you could default on your contract, and we don't want that. Next, they're also going to need to have some expert guidance, because there is a lot of costs that go into your loan. So it's not just your purchase price. It's not just your down payment. There are lender fees. There are fees for your credit background checks. There are fees for surveys. There are fees for appraisals. There's a lot of things that go into that. You want to make sure you know all of this up front. You also want to have a lender, especially if we get into a situation where you find your dream home and you need to make an offer right away. You want to have a lender that you can get in touch with. There are lenders, there are corporations that you can go out, you can get from a big bank that you can get a loan approval from. However, you might not be able to get a hold of them on Saturday or Sunday when you need to make your offer. That being said, we'll talk about in a little bit about how, even if you're using a big bank, how you can utilize a local bank or a local lender with that big bank rate. So next step, so after you meet with me, meet with your real estate agent, you're gonna wanna get a pre-approval. So why mortgage pre-approval? Well, there's two things. First off, there's a mortgage qualified, pre-qualified, and there's mortgage pre-approval. A pre-qualification goes, you go in and you tell the bank, here's what I make, here's my assets, here's my debts, everything like that. They're gonna say, okay, great, you're pre-qualified for this. A pre-approval, you're gonna go in and you're gonna say, this is what I make, these are my debts, these are my assets. And the bank can say, great, now let me see it. So they're gonna verify it. So when you're making an offer on a house, a pre-approval is gonna set you up for success, because a pre-approval, you've already had the banks go through and look and verify what you say is accurate. Or else they also might have to ask you for additional information. Now, this is really important to do it early on, because number one, we can spend the time that we're going to look at, we're going to be efficient servants of our time. And we're going to make sure that we're looking at the right houses to find out which houses that you qualify for as far as purchase price, and also about what you want your mortgage to be, because you might qualify for something significantly higher, but you don't want to pay that monthly amount. So we really want to figure out what works for you. So it's also going to help with our negotiating power, because if you know kind of, hey, here's where I want to spend, but you know that you get approved to a certain amount, that might change how you look at a specific house. It will also help in multiple offer situations. So if, let's say, we find your dream home over the weekend and you haven't been pre-approved, well, we can't make an offer. We've got to wait until you are pre-approved in order to make that offer. And so it also, when you start doing this paperwork, going through all the paperwork, there might be surprises. You might find out that there was something that you were delinquent on, whether it may be an old Netflix account that popped up and you haven't checked your credit, and now all of a sudden something's in collections that you didn't know about. You're going to find out those things early on if you start working with the lender. And honestly, we want to make sure that you qualify for the house that you want. So with that being said, you're going to first choose a lender. Now, I say choose a lender, but you can apply to multiple lenders in a 45-day span period of time without it affecting your FICO credit score. So the reason is that the banks know that you are shopping around. So you're going to have multiple inquiries onto your credit score. It is really, really good for you to shop around. And when you shop around, these lenders are going to give you what's called a loan estimate. And this loan estimate is going to break down, and this is all the way down here. You can kind of see it at number 4. It's going to give you your interest rate. It's going to tell you the lender fees. It's going to tell you the total cost of the loan, your monthly payments, all sorts of things are going to go into this loan estimate. So you're going to find a lender, find multiple. You're going to fill out applications with them. And so with those applications, you're going to submit multiple docs, and it's going to depend on how you are employed. So whether you're a 1099 employer, you're a W-2, you're going to have bank statements, you're going to have pay stubs, you're going to have tax returns, proof of employment. Typically, we see loans, requiring a minimum credit score. In the past, it's been around 580 plus. But it's also going to depend on what loan you're applying for. So whether you're applying for an FHA or a VA loan or a conventional loan, there's also different loans that are specific to specific banks. Banks might have their own, especially you'll see that a lot in like credit unions. They have their own proprietary or their own loan within the bank. So we're going to make sure that you apply to as many lenders as you see fit. And when you do that, and the lenders give you, here is your loan disclosure or your loan estimate, you can then take the loan estimate to different lenders to try and get them to match or beat it. So that's where the big bank, when I was talking about big banks before, you might have a great loan from a big bank. They give you a great rate. Take it to a local lender that you know will pick up the phone on the weekend. See if they can match or beat it. And don't just look at your interest rate. Look at all of the costs associated with your loan. A good lender is going to break down the costs associated and do a lot of explaining to you. And you're also going to be able to pick up the phone and get a hold of this lender. That being said, if you need recommendations for lenders, I have some and I can send them your way. Okay, next, we are going to search for homes. So we've got your pre-approval. We know kind of where you want to be. Your lenders kind of figure out, hey, here's your mortgage, here's where you want to be. So let's look at homes between a certain value. Or you might be a cash buyer, so you don't even need a lender. That being said, for your home search, we're going to need to understand what are your needs versus your wants. So that's a top priority. Whether it's the size of the house, the number of rooms, if you want a garage, different things like this. Maybe it's your school districts. Maybe it is the time that you want to get into that house. The reason we want to understand your wants versus your needs and your list of that is, I will go into a house numerous times with clients and they'll say, I really, really need a house with a bedroom and bathroom on the first floor because I have a family member that can't go up and downstairs, or I have a dog that can't go up and downstairs and they are very old and their hips are having issues. And so I want a house with that on the first floor. Now, I might have a client that sends me a house and it's a gorgeous house. And they're like, well, why didn't you send it to me? Well, that need of yours of having the house, the bedroom on the first floor is that. That being said, we can go see it, but I need to clarify with you, is this a need or is this a want? And if it's a need, it is my job as your program manager, as your real estate agent, to circle back and make sure that we truly hit on those specific needs and wants when we go in to start looking for your house. So that's something to take a minute, go through and kind of make your list of what you think are your needs, what are your wants, and then relook at your needs and relook at your wants and see if they need to be on opposite sides. Because sometimes when you first write it out, that might change. From there, how are we going to search for your houses? So first off, the obvious, there's the agent search. So we have within our boards, we have an MLS search. So that's going to be like the master listing search that we're going to look at everything that agents have put online. We're going to look within our agent networks. Maybe there's stuff that isn't online yet that are pocket listings, especially if we get into the luxury properties. There are a lot of luxury properties that you won't see on like the Redfin, Zillow, on the normal MLS, and they're in different avenues, and that is my job as your real estate agent to go and find it. As well, maybe there's the builders. So builders have a lot of homes that they don't necessarily put online immediately. They're holding those homes in their back pocket, waiting for it to reach closer to completion so they can kind of figure out, well, where am I going to price the house? So perhaps there's a specific house that you're looking for, and we can get into that network and that niche of builders ahead of time. And maybe you have a longer buy box window, meaning you don't have to buy in the next month. Maybe it's a few months, maybe it's a year. We can kind of go into those builders and really figure out what is appropriate for you. Also through our website, kind of seeing, hey, what is out there. In Austin, there is a type of listing called a flex listing. A flex listing is a listing where every single agent can see. It's almost like a coming soon, but every single agent is, as a part of the MLS, as part of our board, we can see it. However, it is not customer facing, meaning you're not going to find it on realtor.com, on Redfin, on Zillow. We're going to have to see it on our end. So that's also why when you start searching, it is good to get in contact with a real estate agent. Now, if you're buying in Texas, if you're buying even outside of Texas and you need a referral for an agent, message me directly and we can kind of figure out who might be the right fit for you or multiple people so that you can interview them. Now, you obviously, as a consumer, are going to be looking on sites. You're going to be looking on Zillow. You're going to be looking on Redfin, realtor.com. You also might be driving in a neighborhood and see yard signs. that is okay. I highly encourage, if you do that, fine, phenomenal. Send it to your real estate agent if you find something that maybe they didn't send you. The reason behind that, well, they might have, like we talked about it, a bedroom on the first floor. Maybe there is something that you said is a need that house doesn't qualify for. Maybe it's that we see that there wasn't a garage, or maybe the school that you were looking specifically for doesn't fall in that area. Or sometimes maybe it was just an oversight. So at the end of the day, it's not an adversarial relationship with those websites. Those websites are phenomenal. Their search engines are phenomenal. At the same time, let's use all the tools to make sure we find you the best house, or the one. And then from that, we'll also have some automatic home search systems that will send homes directly your way. Now, buyer beware. This is where everyone likes to get information as quick as possible. And so you will be online, and if you're on these sites, you're going to see these requests for a tour, thinking of buying, everything like that on all of the main websites. That being said, if you want your phone to blow up, if you want 3 to 10 agents calling you in a matter of minutes, and you're maybe even have a signed representation agreement with another agent, if you click on one of these links, you've essentially sent your all of your information out, or these companies have, to agents that are purchasing leads. So agents, it's not going to the seller's agent. It's not going to that listing agent. It's going to agents that have paid these companies to get leads. So you don't know the quality of the agent that you're getting. You're also going to have multiple agents reach out. If you want to see a home, the best thing to do is send the listing that you find. So if you find it on Realtor, Zillow, whatnot, send it to your agent. Let your agent or myself find the right time to show you the house. And also, when you see these times and when you see these dates, it's not confirming it. At the end of the day, whatever agent shows you the house, they have to confirm with the seller. They have to confirm with the listing agent. So it's not a definitive of this is exactly the time that you're going to see it. All this is at that point is they've sold your information, and there's people taking you on as a lead. Okay, from here, let's say we do find some amazing houses. We've gone out, we've toured some homes, we've found some phenomenal houses. What we're going to then do is some of them before we go out to the houses, depending on how many there are, and maybe some of them are after, but we're going to ask the listing agent for what we call the seller's disclosure. So think of this as almost like the lemon law for cars, but for houses. So what is required is for sellers to give any known defects to the house. They have to disclose any known defects to the house on this thing called the seller's disclosure notice. Now, that being said, are all defects disclosed? Most likely not. And that is why we do a home inspection. And we're going to get into home inspection later on. But your seller's disclosure notice, you're going to want to see that up front because, for instance, maybe there's a mold issue, or there's a water issue, intrusion issue. You want to see that before you make an offer. So it's really, really good to have that ahead of time. And maybe it'll deter you from making an offer. Now, unlike some other states, the seller goes and has a home inspection done ahead of time. I highly recommend it for my sellers. That being said, in Texas, it's not required. And we're going to talk about a period of time called the option period later on down the road when it comes to doing inspections and what that means. So hold on tight if you're like, wait a minute, the seller's not giving me an inspection. We're going to talk about that. We're going to get to a solution for you. So with that, after we search for your homes, we found your dream home. We've seen the seller's disclosure. We've also seen any other disclosures that they have to give us. So maybe it's a lead-based paint. Maybe it's a mud or a water district, and there's different fees associated with. We are going to make an offer. So what is involved with making an offer and negotiating the contract? So the first thing that I'm going to do is I'm going to do what's called a comparative market analysis. Now, this is the foundation for us making your offer. This is not an appraisal. I am not a licensed appraiser. This is just information on homes that are in the area where you're looking that have recently sold. This is one of the main tools that we do to determine what is the right offer price for you. That being said, we hit on, and you're going to see, hey, these are the comparable sales. You're seeing this right here. But what's next over here is you're going to also see that I'm also looking at current listings. And you're going to see where I write micro and macro analysis. Now, not every real estate agent may give you this. I really, really like to give this information. So when we're looking at making an offer, we're not looking at just what is sold, because what is sold, we typically look about 3 months back, depending on the area of the house. I like to look at plus or minus 20% of the square footage. I like to look within a 1 mile radius of the house, because I want to ensure that we're comparing apples to apples. I don't want to look at new construction on a house that's in 1954 reno. I want to make sure we're looking at the same. That being said, the really good, I say, comparable houses are going to be those houses that have gone pending, because they're probably going to close out before your house that you make an offer and does. But you also want to see, what was it going for? As well, you want to look at the inventory. And that's where we're going to look at the active houses on the market, because we want to see, is inventory starting to stack up? And typically when that does, we see prices drastically drastically falling, and we'll see a lot of price cuts happen from sellers. So don't just look at, hey, here's 3 houses that are similar, and use that to make your offer. Ask for other information. Ask for what the active inventory is. Ask for what is pending. See what is happening around. How many months worth of supply is going on in the area? What is the close to list price ratio in that area? What are houses going for? Are they going above asking, below asking? What does that inventory look like? So we're going to look at that data, and we're going to use all of this as a basis for when we make our offer. We're not going to just hop on and look specifically at what those 3 houses sold for. There's a lot more that you need to do. That being said, the offer. So what goes into the offer? So easy. The sales price. That is the most obvious that you're going to see, is the sales price. And that's going to be based on that CMA that we talked about, that comparative market analysis, and what is the current market conditions. Next, we're going to look at the days to close. Now, it used to typically be about 30 to 45 days for loans. That's how long it took to close. That being said, a lot of lenders are doing, they're pre-underwriting the loan before they even get to a house. They are getting in the weeds on your loan application so they can close fast. I've had lenders that have been able to close deals in 15 days. There's one a little bit quicker than that too, but I'd say 15 days, that was extremely fast. Now, 30 days is kind of the maximum that sellers right now really want to have your house under contract for. So it's really, really good, especially, once again, a local lender versus a big bank. I typically see local lenders able to execute significantly faster than big banks. That being said, depending on where you are and your relationship with the big bank, it might be, you might have all sorts of investment assets at this bank, and there is a specific portfolio loan. And that's what I was trying to think of earlier, portfolio loan. So we talk about the FHA, VA, conventional. Well, there's a portfolio loan that they might have that works to your advantage with that. For cash deals, I mean, they can close, I say 10 days, but I will say, a couple years ago, I had someone come 6 days before the end of the year and say, I need to close a house now. We got a house, and we were able to get them closed within 6 days. Now, that had a lot to do with the title company. So cash, you can go extremely fast. That can happen, and I'd say up to 30 days. Once again, a seller doesn't want to tie up their house significantly longer, especially in a changing market. And that's going to, the fewer days, the more competitive your offer will be. Next part of your thing. So we have your sales price, we have your days to close. Then we're going to have what's called earnest money and option money. And we're really going to get in details of what those funds are on the next few slides. That being said, your earnest money, it's typically about 1% of the purchase price. And that just shows good faith when you put your offer in. That's going to be due within 3 days of going under contract. That being said, it's kind of a good faith that you're not putting offers on 15 houses and have 15 houses under contract. It's showing, hey, this says we're under contract, good faith that I am going to buy this house. That will also go towards your closing cost / down payment. Now, if you are looking at a luxury home, different price points require different amounts. So there may be a home at a luxury price that is requiring significantly more. When we were in that COVID area, that 2020 to 2022, I was seeing earnest money be 2 to 5% of the purchase price because buyers wanted to relay to the sellers that they were incredibly serious about their offer. The next part is going to be what's called the option money and option period. So option money and option period. So in Texas, we talked about how maybe there's other states where you get an inspection up front from the seller. In Texas, typically the buyer is the one getting their own inspector and inspection out there. What we do in Texas is we negotiate for a set period of time called your option period. And it typically, the money and the days are going to depend on the house as far as the condition of the house, when you can get an inspector out. Typically the option period, and we'll go more into that, is about 3 to 10 days that we'll go into about what that truly means and what are those numbers. Finally, we have the title policy. This is going to be required from lenders. Typically right now we're seeing a lot of sellers pay for it just based on the market. Now, when we were back during that COVID time and the market was extremely hot, we had buyers paying for it. It is a little over 75 or 0.75% of the loan price that you're going to see what it is. But your real estate agent should be able to break down what the approximate price for the title policy is so that you have an understanding. Right now, though, we're seeing a lot of sellers pay for that. And then the other thing is that the home warranty. Now, home warranty is going to pay. A lot of times you'll get a seller that will pay for the first year home warranty. So if anything breaks, electrical, mechanical, plumbing wise, it may be covered by this home warranty where you pay a service fee. The one thing that's not on here is the commission. So commission is negotiable. As a buyer, you will need to sign a buyer's representation agreement. In the buyer's representation agreement, it'll break down the commission, and it'll break down that the agent's first thing is to try to negotiate it from the seller. In today's market, we are seeing the majority of commissions being paid by the seller. That being said, I'm not going to talk about numbers or percentages and everything like that, but that is also another discussion to have with your real estate agent of how do you get paid and what does that look like for me in the case as far as commission goes. So you'll want to talk about that, and they'll break it down for you. Okay, going back to that earnest money. So that earnest money, once again, it was 1%. It's also going to say that it also varies by new home construction. New home construction can be more, can be less. This is going to go to the title company once you go under contract. It's due on the third day after preceding the execution date. So let's say you write an offer on Tuesday, you get it accepted on Tuesday, then that means the first day is going to be Wednesday, Thursday, and Friday, meaning it's due Friday. But let's say you don't execute until Thursday. Your first day is Friday, and then you go Saturday, Sunday. Well, Sunday, it's not a business day. You can't go in. So it'll roll to the next business day. So it'll roll to Monday, unless it's a federal holiday or bank holiday. That being said, that is due within 3 days of going under contract. So you want to make sure that you have those funds easily available. So if you are cashing out assets, in order to do that, you want to make sure that you have that discussion in advance and either have those funds waiting or have a quick way to get those funds out of the account. This will also go to your closing cost and your down payment. Now, if you decide to back out of the contract, and that's during the option period, which we'll hop back in and we'll talk about in a minute. If you decide that you don't want to buy the house during the option period, this money is completely refunded back to you. That being said, there are like 32 plus other outs in a contract for a buyer. The buyers have a lot of outs in the contract. My job as a buyer's agent is to keep as many of these outs open as possible so that you can get out of the contract if something was to happen. As a seller's agent, my role is to close as many of these outs. So there's everything from like HOA docs, there's things from your loan approval, different things like that. That being said, do not rely on that. Your option period is your best chance. So if you decide that you don't want this house and you want to get that 1% back, the option period is the best time to terminate the contract. That being said, if you default, let's say you get all the way towards closing and you decide, you don't want the house. one of the main remedies for defaulting on the contract is that the seller will then keep the earnest money. That is not necessarily always true. This is not legal advice at that point in time. If you were to terminate, we would also ask you to get an attorney involved, just so that you understand the possible outcomes from you, repercussions from you defaulting and terminating the contract, and what that can look like. Because ultimately, the seller could force you to go to court to buy the house as well. So this is not legal advice. This is just one of the things that potentially does happen, is that if you default in the contract, one of the remedies is that the seller would then keep the earnest money. Okay, the option period. Okay, so the option period in Texas, this is the time where we are in a unilateral contract. What this means is it's the only time when you, the buyer, have the ability to walk away for any reason. You can walk away because you decide, I just don't like this neighborhood. You can decide that you don't like the layout of the kitchen. You can also have the house inspected and decide, ooh, this house is a money pit and I don't want to get involved. So this time is called the option period. This is the time for you to do any inspections and also renegotiations. Typically, we see option periods anywhere from like 3 to 10 days. When we were really, really hot in that 2020 to 2022 time period, you did have some people waive inspections. At the same time, you also had like a 3-day inspection or a 3-day option period. Now, does that necessarily mean you'll get an inspector in during that time? Maybe not. So it might be behoove you to have a little bit longer time period. Right now, I'm typically seeing inspectors. You're able to get an inspector in the house typically between 4 to 6 days easily. But what I would also say is, before you execute your contract and you make your offer, you want to understand the availability of inspectors, because you don't want to have an inspector that can't come until day 7 and you negotiate 5 days. That's very important. So work with your agent. That's where I come in as a program manager to make sure that we can get an inspector out there within our option period. I highly, highly, highly advise you do not waive this, even if it's a 1-day inspection. Let's say something happens and you just change your mind. This is to your benefit to have that. Now, that being said, the cost of your option period is going to vary by a few things. It's going to vary by the price of the house. It's going to vary by the location. It's also going to vary by the number of days. So I said, for instance, right now in Austin, a $500,000 house, you might be looking at $200 for 7 days. A $1 million plus house, $1 million house, you might be looking at $500. You might go to 1.5 million. You might be at that point at like 750. Going back to that COVID period, that 2020 to 2022, you were looking at, regardless of the price of the house, you were looking at $1,000 for like a 7-day option period. You could have a $300,000 house and you were looking at $1,000 option period, which means that if you, the buyer, decided to walk away anytime during that option period, that option money stayed with the seller. So if you terminate the contract, that is the one thing that unequivocally does not get refunded, is your option fee and your option money. If you go to closing, that goes towards your closing cost and your down payment. So you do get credited that back. But if you terminate, it does not. Now, that being said, it's also going to depend on if you're having multiple offers. If you're having multiple offers, your option money might be higher as well, because you want to show the seller that you are serious about this house. Just like the earnest money, this option money is going to be paid to the title company within 3 days. So you're going to want to have your option money. You're going to want to have your earnest money. This is all going to the title company. Think about your title company as like your middleman, the middleman that goes between both the title company escrow officer. So in Texas, it's one. I know in different states, you might have different individual that holds money and title and escrow. They're all different. In Texas, it is one individual, one company that is doing, I say, all of that work. That being said, during the option period, you can terminate for any reason. You can also negotiate. So this is when it comes to when we have your inspector out there, and if we find issues, we can also negotiate repairs. We can negotiate money towards closing costs, and we'll kind of get in that in a minute. So we're going under contract after we've negotiated with the agent, the seller's agent. We're going back and forth, and congratulations, you are under contract. How does that work? Well, First off, once you go under contract and your offer is accepted, you're really starting the full loan process. So before you had a pre-approval, your pre-approval was just based on you, but it wasn't based on the property. We're going to really get into the nitty-gritty details once you go under contract. Once you're under contract, we're going to go into the nitty-gritty details of the loan process. So you already kind of have your application, it's already going. The lender's going to process it, but this time they are going to add in that house, because when you add in the house, all of a sudden now you're dealing with, if it's a house versus a condo might have a higher interest rate. You're also going to deal with what are the taxes, what are the special assessments that might be associated with that property. Is it in a flood zone? Is there different insurance that you're going to get? That is all going to happen during this process. So they're going to ask you for a lot of information, the lender is, during this time. You're going to have given them bank statements already. They're going to ask for it again. You're going to have given them income verification, meaning you're going to show that, hey, this is what I make, that I'm still employed. They're going to ask for a proof of employment again. There is a lot of things that are going to go in this process. You're going to also, at this point, you're going to have to shop for your home insurance. That is another thing. Once again, program manager, real estate agent, I'm trying to help you find those different people. That being said, anyone, it's not necessarily a referral, it's a people that have done a good job for clients prior. I always recommend that you get at least 3, talk to at least 3 people. Make sure that you get what is right for yourself. During the underwriting phase, they are also going to do the appraisal. And that's also, you may waive your appraisal. Like, let's say you're putting 50% down. You might waive your appraisal. Your lender might not require an appraisal. However, let's say you're putting 5% down. You're most likely going to have an appraisal, and that is going to happen during this process. So during underwriting, they're going to make sure that you qualify for the loan, but also the house does. And they're going to ask for additional information from you about your finances. Now, once all that's done, once they've underwritten you, once they have cleared the house, the appraisal, it's made value for appraised value, you're going to get the, hey, you're cleared to close. They're going to give you the final numbers of what you're going to owe at closing, and then also what your monthly mortgage payment is going to be. Now, the Truth in Lending Act also requires that lenders, so when you first got approval, within 3 days, they had to give you that loan estimate. Now, when we are going and you're under contract, before you close 3 days prior, they're going to also give you a Truth in Lending. They're going to break down your final settlement statement. And they're going to say, hey, here is what the true cost is. The reason they tell you that is you want to be able to compare both that initial, when you first went under contract, to right now before you close, to make sure it's very similar as far as what your loan estimate is. And that, to make sure that you're not all of a sudden, fees didn't go drastically up from things that you did not select. So 3 business days prior, they're going to make sure that you have the loan estimate or your final settlement statement, your numbers. That being said, I've had lenders who shall remain nameless. If they don't get this to you within 3 days prior to closing, your closing is going to be pushed. They have to get this to you. If they do not get it, it will push. Now, that being said, if you're pushing your closing date, just be aware that technically you may be in default. And so that's, once again, important that you want to make sure that your lender is reputable and trustworthy, and they can execute when they say they can. If for some reason they can't close on time, you're going to have to negotiate a extension. So you want to make sure that your agent also has a good relationship with the other side, so that you can negotiate an extension to the closing date. That being said, if there is multiple offers and you were selected, there might be a higher backup offer that is in play. And if there's a higher backup offer in play and then you cannot execute on your closing, there's a chance they could terminate the contract and go to that backup offer that might be higher. So this is why your lender is so critical and important in this. And so you got clear to close. You're going to go to closing. It's going to be a great day. Let's get away that negative stuff. You're going to go to closing. It's going to be a great day. They're going to give you kind of, here's what your final cost of, here's the total cost of the loan. You're going to review that. You are going to sign on closing date. Congratulations. The house is still not yours. The house does not become yours until it is fully funded. So that's, both sides have signed the contract. All the documents have gone to the lender, who's then reviewed it, and they've said, yes, it all checks out. They've double checked on your credit. Your credit will be checked up until closing. So don't go buy your car. Don't go buy a hot tub. Don't go buy a high expensive item if you have a loan. So if you're doing a loan, because that could change your debt to income ratio, which could then change what your interest rate is. There's a lot of things that go on. So just hold off on any major purchase if you are using a loan during the process. That being said, is once all these funds are distributed from the lender and you've submitted your closing costs, the cash that you need to bring to closing, that's when the house becomes yours. And then that's what we call funding. I say that because if you sign on a Friday and something happens and you're ready to move in this weekend and it doesn't get funded until morning, the house isn't yours. So I highly, highly advise, if you can avoid a Friday closing, if you can go Thursday, that's kind of better, because then the next day, if something happens, you have a day. Also, do not recommend having movers the day of closing. You want to make sure you've got time, and maybe the next day you have your movers come out. So once again, this goes back to being a program manager, explaining all these different nuances to you in this process. But the good thing is that the home will officially be yours once it is funded. But that is how the loan process works. Now, remember, we are back under contract. You just got excited. You started the loan process. The other thing that's going to be happening is the home inspection. The home inspection is your due diligence period. This is so that you know what you are buying before you are buying it. Things that you should that you should understand. So first off, in Texas, there is a standard operating procedures that a licensed inspector has to do according to the Texas Real Estate Commission. They have set, here's what I'm going to do. They're going to look at your roof, your foundation, your HVAC system, plumbing, electrical, windows, so many more things. That being said, they're going to look at all the components of your house. For the basic inspection, it's going to be based on your square footage. So the smaller the square footage, I say lower the price of the inspection. So it could be on the low end, like a $400 inspection. You could also end up having a $1,500, $2,000 inspection, depending on the size of your home and what all goes into it. Because that is the basic home inspection. If you're going to have your pool inspected, which is separately, if you are going to have your home and have what is called a sewer scope. So a sewer scope is going to look at all of the drainage from your house that flows out to the street. I highly, highly, highly recommend that. They're going to see, if it's an older home, they're going to check for cast iron plumbing. They're also going to see that even though you might have PVC, even though over time, and it might even be a new construction home, there might be a blockage in your sewer line going out to the street. You also might have what's called a belly. So you might have a tree that's been sitting on your line that's pushed it down, and now it's kind of got a belly, and there's water or there's drainage that's backing up into it. A sewer scope, I can't tell you how much I highly, highly encourage it. There's also an additional fee if you have a pier and beam versus a slab foundation house. You're going to want to understand this. You're also going to want to talk to your real estate agent to kind of give you insights. If you're doing a VA loan, you are going to have a wood destroying insect. So you think about termites, you're going to have a wood destroying insect inspection. And that is important because the VA is not going to, if there is termites, it's going to be, there's certain remedies that need to happen in play if there's termites, or if there is conducive conditions for termites or wood destroying insects. So everything will also play into that total cost of your home inspection. You also maybe want to have your sprinklers checked. There's different things that go into that. Okay, so that's kind of cost. So you're thinking anywhere bare minimum 400. If you're at like a 1,300 square foot house, the larger you go, the higher the cost goes. But you want to make sure that, hey, I'm going to pay that. You can pay that. Typically, you can pay that with credit card. You can pay it with cash. Not cash a lot of times, but credit card or a check as well. So make sure you have the money and the funds for that. And when you start looking at houses, you can ask your real estate agent, what is the approximate cost of that? Why this matters. You should always have your home inspected, even if it's a new construction. New construction, yes, they have inspections. However, it's a fox guarding the hen house. It is their own inspector. And yes, even though the city comes out. And the other thing is that we are all humans. Humans built these houses. So no home, I say this and someone might say, oh, mine is perfect. Humans built it. There is human error. So you look at an inspection of, hey, this is way to understand what decision I am getting into financially. What is this house going to cost me? What are the repairs going to come out that? This is protecting you and protecting your investment. Let's say we do find things that are wrong with the house. There's different avenues that we can go. Number one, we can negotiate for the seller to make repairs. If we have something that is a high ticket item, like for instance, the roof, roofs are huge, especially with insurance. Like if you have an over 10-year-old house or 10-year-old roof on a house, you're most likely probably going to want to negotiate to have the seller to replace the roof or give you significant funds so that you can do it yourself. That goes into your home insurance and how that's affected. I could talk all day on that. If we get to that situation and you have an older roof, let's talk. Let's figure that out before you go into it. Also, don't let it deter you from making an offer on a house with an older roof, because I've negotiated numerous times for a seller to replace the roof or give funds towards closing for the replacement of the roof. That is incredibly important. So it also might be plumbing that we need to do. We talked about the bellies in the sewer lines out. We might have to have them replace it. There might be HVAC issues that we want to have them repair. So bigger ticket items, you might ask for them to actually repair, especially if there's potential unknowns that come out of that inspection. That being said, sometimes it's better for you to get money towards closing costs so that you can do the repairs yourself, because a seller is, not all, but a lot of them are going to do it fastest and cheapest. If you are the buyer and you're buying the house, you can control the quality of the person that comes through and does those repairs, the scope of the work. You can also make sure there's warranties, different things like that. Now, I highly recommend that if it's something that might have 3 or 4 things that come out of that repair and could cost you more money in the long run, that you maybe do push it on the sellers to do it in advance. Otherwise, let's get the money in your pocket to offset closing costs. That being said, depending on the type of loan, depending on how much money you're putting down, and depending on what the closing costs are, there is a certain limit that you can actually get from the seller. So once again, this is why it's really, really, really important for you to have a knowledgeable agent, because you don't want them to negotiate an amount that you can't use. Because let's say you negotiate 7% of the purchase price towards closing costs. There's a little line in that contract that essentially all the potential closing costs that can be utilized, anything else goes back to the seller. So like, let's say your lender does not have enough things to utilize in that closing cost, it goes back to the seller. So you want to make sure your lender is, aware of what's going on, that your agent's aware of what's going on, so you negotiate appropriately. The final thing is that you can just back out. I had a house that we went into and there was just so many issues. I was like, this is a money pit. I was like, you do not want to get involved with this. It's ultimately my buyer's choice, what they want to do. But I'm going to highly advise, like, if there's multiple issues and I see that, hey, this could be a long-term money pit, I'm going to tell you. Or the inspector is going to tell you, not me. The inspector is going to tell you, but we're going to kind of talk about that. That being said, it ultimately is your decision whether or not you purchase the house. I had one that there was water intruding, coming down a hill into the garage. It was flooding the garage, potential mold. But even though the seller could not find that issue, well, they could give us $10,000 towards closing costs to find the issue. But water's very sneaky. And so unless we have it pinpointed, and even if we have it pinpointed, how we correct it, it might not work. So that's one of those things that you want to make sure that whatever house you're getting under, that you can handle the known issues that have come up. With that, if you terminate, like we said, option period money is not refunded. Now, your mortgage payment. So let's understand a little bit. So if you are a cash buyer, you can just completely disregard this. You can zoom forward ahead. That being said, understanding what goes into it. So first and foremost, it's your principal and interest. Now, if you have a fixed mortgage, if you have a 30-year conventional and VA, FHA, this principal and interest, they're not changing. That's staying the same. If you get an ARM, an adjustable rate mortgage, depending on the years, that will change depending on what year it is. The only other reason, and I won't get into this, but there's things called 1-1, 2-1, 3-1 buy downs. We're not going to go into those details. That's the only one of the other exceptions to the rule. There's some, but we would look at your specific thing. But for the most part, principal and interest is not going to change. Then they're going to do, if you have less than 20% down, the majority of times your lender is going to escrow your taxes and your home insurance. So your property taxes, be aware, they can change yearly. As the value of your house goes up, there's a high probability that your taxes will go up. Now, in Texas, we have, if it's your homestead, we're limited by like a 10% increase in cap per year. That being said, it can still go up. So you want to be aware of, can you afford the house now? But can you also afford it if this was to go up over the next 3 years? Can you still afford the house in 3 years? So you want to make sure that you buy within your budget for your house. Homeowners insurance. We have also seen that go up over the course of the time. Homeowners insurance, you buy essentially like a 12-month policy, and then every 12 months that goes and it's rebought by your insurance. So you'll pay a sum of your taxes and your home insurance up front, but then it's also going into your escrow account monthly. So you have your principal and interest, you have your property taxes, and you have your home insurance. I have clients that do have a loan, but maybe they put so much down that they don't want to escrow that, and they keep it in an account separately, a high interest bearing account, and they pay it off whenever it's due. You can also do that. So it's going to really be dependent on your situation. If you are putting less than 20% down, there's a chance that, or you're using an FHA loan, you're going to probably have mortgage insurance. And so mortgage insurance essentially offsets the risk of the lender that's lending you the money, because you're underneath as far as the equity that you have in your house. It protects the seller it protects the lender so that if you default on the loan, they do have some remedies there if you go into foreclosure. That being said, if at one point you get over 20% equity in your house and you're not an FHA loan, you can't get rid of it, but your conventional loan, you can ask for them to drop the mortgage insurance. That's a whole nother discussion for my own homeowners later on down the line. So that being said, that's also why it's not a transactional relationship with your real estate agent. Knowing that over time and knowing that, hey, property values have changed and all of a sudden now you've got 20%, you might want to ask your lender to take off your mortgage insurance. And then finally, this is not a part of your mortgage payment. However, you do want to factor in what are your HOA dues. Your HOA dues will play a factor. So whether you're in a neighborhood and your HOA dues are maybe a couple hundred a month or $1,000 plus a year, or you're in a condo downtown and your condo downtown is maybe $1,000 plus because the square footage of your condo, that is all going to be rolled into like, what is your monthly affordability? Okay, cost breakdown. We're getting there. We're getting close. I'm proud of you. Hang with me as we go through this. So the closing cost breakdown. What I just want to say is your closing costs are not just your down payment. They're not just your taxes. They're not just your insurance. There is a lot of things that go into it. That is why it is important that you get a loan estimate from your lender up front. So if you see right here, you see all of these costs right here. This is all going to go into what you need to bring to the closing table. This also goes back into when we negotiate during the option period for money towards closing costs, it kind of helps pay for some of these items. Now, the appraisal process. The lender is only going to lend you up to what that house is worth, or up to what the house is under contract for. So an appraisal. So I'm going to do a comparative market analysis. I'm going to do and say, hey, here's what the market value is coming out for what we're seeing based on everything close. I am not an appraiser. I am not giving you appraised value. That being said, your lender will order an appraisal, like especially if you have under 20% down, even 25% down, just depending on your lender, they're going to order an appraisal. An appraisal is going to give you an unbiased professional estimate of what your true market value of your house is. They will make sure that whatever you offered is what the house is actually worth, that, because they're not going to go and give you money on a house that is worth significantly less. That being said, it is paid by the borrower, by you. Some lenders require you to pay it up front, whether it's by credit card, check, it's paid up front. Others might not make you pay it until you get to closing. It's just wrapped into your final closing cost. Talk to your lender about when you will have to pay for the appraisal fee. This is just so that you're aware that you have those funds available. Two different scenarios. One, the house appraises above value. So let's say you're putting a 5% down payment. So these are especially a lot of times my first-time home buyers. You are putting 5% down. You're putting $25,000 down. So they're going to loan you $475,000. it appraises for $520. The bank is still only going to loan you $475,000. They're not going to then go and give you more money because it went higher. They're still going to require that you put 5% of the purchase price down. Now, if we go over to this other scenario right here, scenario 2, it's $500,000. You're putting that $25,000 down for the 5%, but it only comes in at $480. So at that point, you have to pay either the difference. So you said that $25,000 that you're already putting, and there's an additional amount that's going to kind of bridge that gap of what it doesn't pay. So you're still going to pay 5% of this $480 plus the additional what's missing on top of that $20,000. Now, that being said, in conventional loans, you can pay the difference or you can negotiate the price. With a VA and FHA, it has to appraise. If it doesn't appraise, you can walk away. Same with conventional. But what I will say is, for the VA and FHA, you have the ability, people still have the ability to pay the gap. They typically will see it more with the VA. So just because it is a VA loan and you're a seller doesn't mean you shouldn't accept a VA loan either. The VA does have the ability to. Now, you'll sign something that says that they can walk away, they can terminate it. But that's, I think, just part of the whole offer process. So just know that your house has to appraise, or else you're going back into negotiations or you're terminating your contract. Do's and don'ts before you close. Okay, this should be common sense, but it's not common sense, and I can tell you because I've seen it. So first, this whole process, time is of the essence, and that means that there are critical steps that happen along the way that they need information. So make sure that you give all your documentation in the time. You're also going to watch your credit report. You're going to make sure that something doesn't come up. I had a client once who had, and I brought this up earlier, Netflix. They had moved the house and they had an old Netflix account. They did not know about it. It went into collections. They had moved from California. Their collection notice was getting sent to their California address, and they weren't monitoring. It was kind of like a junk email. We got to closing a day before closing, and all of a sudden they found out that they had, it was like $45 in collections, but it dropped their credit rating, their credit score, to where it then dropped their interest rate. And so it's really, increased their interest rate. It's really important to monitor your credit reports. If anything comes up, you can address it accordingly. You're going to make sure that you have your earnest money, your option money, all of that available so that you can provide it timely. If you are getting gifts, this is not uncommon. This is not uncommon for family members to gift money to purchase houses. So whether it's a small down payment or it's the full, like it's $700,000, $800,000 down for a down payment for a house that has a loan, they're paying a substantial amount. It is not unheard of. I hear it. I get numerous ones every year. Probably get it between 25 to 40% of my buyers that are first-time home buyers will have a gift from a parent or a family member. That being said, that money has to be accounted for. So you're not only going to have a gift letter saying that this is a gift and it's not a loan, because if it's a loan, it's going to affect your debt to income ratio and what you're having to pay out. So you're going to have a gift letter saying who it's from and that they're giving it to you without a loan attached. And then 2, on top of that, they're going to have to show where that money came from. So just be aware, if there's gifts coming, they're going to have to show the lender where this money came from. Obviously, you want to stay employed at your current job. If you decide to quit, that could drastically hurt your chances of being approved for your loan. Also, you want to make sure that all your debts are paid on time. So that's kind of easy, like stay on top of your debts. Now don't close any accounts without proper documentation. So don't go pay off your car early. Don't all of a sudden close out a credit card, because that can affect your credit score. Talk to your lender before you do anything. Don't change your jobs without it. Don't also deposit big, unusual sums of cash. So if you are someone that likes to gamble in Vegas, you are going to have to show where all that money comes from. And they're going to have to make sure that as far as like taxes, different things like that are associated with that funds. If you're using large sums of cash for your purchase, and let's say you have it sitting in a vault somewhere, get it in your account and have that money seasoned and be there for a while before you could then go and apply for a loan. Because if it's not, they're going to have to ask where it came from. I had one first-time buyer, and they were very close on all their numbers, and they actually sold a bunch of their furniture on Facebook Marketplace. They had to show all of their sales, and that's where that cash came from. Depending on what kind of buyer you are, you may be asked for documentation of where this money came from if you're getting a loan. And then don't make any major purchases. So I had another client unfortunately get into a car accident and total their car. They had to have a rental for 2 weeks until we closed because they did not want to have a hit to their credit score by applying for a car and then also purchasing a car. And then make sure you just have documentation on whenever you transfer funds that it is accounted for. Okay. Oops, I went back. We're getting close. Okay. Final details. So final steps. So during this whole process, that escrow officer, that title company, they're going to be doing a title search. They're going to make sure that the seller has the ability to sell you the house and that all liens that are associated with that house are paid off. So whether they have an old mechanical lien, let's say you have solar panels, there might be a child support lien that's on that house. They're going to make sure that all of that is either paid off at closing or previously paid off. It's all there. You're going to get your closing disclosure 3 days prior to closing. Once again, this is the, hey, here's all the money you owe. Here's your final cost. You're going to line by line that with your agent. Your agent's going to do that as well. They're going to make sure in your closing disclosure that you're getting credit for your earnest money and your option fee. They're also going to make sure that you're getting, if prorated taxes, that you're getting the prorated taxes. There's a lot of little fees that are on there. So it's not just I say pencil whip and sign. Just make sure you look at that. We're also going to do repairs. Any repairs that were required during the option period, we're going to make sure that those repairs are done. Depending on the extent of the repairs, you may want to have a specialist come out and re-inspect it. A lot of times people will just show proof as far as like the HVAC repair or the roof was done, different things like that. You might need to have a specialist come out in to inspect the repair was done correctly. Now in Texas, if it is like for instance, a plumber that's coming out and there's a plumbing repair or different repairs, it might require a permit. And so that might have to delay closing or it goes into it. You also want to get any warranties that go along with those repairs. So you want to make sure you have those up front. After we make sure all those repairs are done, we're going to do a final walkthrough. We're going to ensure that that house is in the same condition it was when you first made the offer. And the reason that is that a couple things. One, people move out. There's mistakes that happen. Chairs go into walls, couches come down the stairs, washer and dryers get unhooked, and then the water leaks in the back of the wall, and you've got to have a repair for that. Or this is a while back in like the 2008 timeframe when people were getting foreclosed on. You were having before they were getting foreclosed on, they were underwater. You were having sellers take appliances or take chandeliers, anything that is affixed to the house. So if it is attached to the house, it stays with the house. So we're talking TV mounts, we're talking all of the drapes and the blinds, they're all staying with the house. We're making sure all of that is still there. If it's not, we're stopping or pausing on closing to make sure that it is corrected. That being said, Texas used to have something in our contract that was required that the seller remove all of their personal items, debris, and also have the house essentially clean to turn over. It is no longer in the contract. So if you are writing an offer, you want to make sure that the seller is responsible for removing all personal effects and they're all out of the house. So any personal items, personal debris is taken out. You want to write in the contract that it is professionally cleaned as well when they turn the house over to you. So we're going to do the final walkthrough. We're going to make sure all of that's done. If there's something not done, we're going to pause and we're going to need to have the seller repair it. We're going to get a concession for that. Side note, in Texas, your refrigerator and washer dryer do not come with the house. That has to be written in what's called a non-realty addendum, or you can do a separate bill of sale. So don't assume that there's a refrigerator, and even if the house is vacant, don't assume this refrigerator stays. You need to get it in writing as part of the contract that that refrigerator stays, and mark what kind of refrigerator, or per the pictures, the listing photos, make sure that that is well documented, that that refrigerator or washer and dryer stay if you've negotiated for it. And then finally, we are going to get to closing, and closing is where you are going to sign all your documents. And at closing, you are going to bring your ID, and you either bring a certified check for the funds of what is due for cash for closing that was on your final loan estimate, or you're doing a wire transfer. Typically wire transfers, I also say, try and get that like a day before in case something happens, you've got some wiggle room. And that being said, closing day, Very, very excited for closing day. We'll be there with you. Or if we're not there, there's sometimes something random happens or we're out of town or something. We'll make sure we're available by phone, that we can also go through everything with you at closing. You're going to bring your valid government ID. So if your ID expires, make sure you get that renewed, or you have your passport. Make sure that you have all your funds to close. If you, in Texas, if you have a loan, you are signing and you're wet ink signing. Now, if you are a cash buyer, you can sometimes just sign remotely. You don't need to be there in person. But if you are getting a loan, you are going to be having to sign some documentation in person. If you cannot be there and you're outside of the US, you're more than likely going to need a power of attorney. Or let's say you're in the US, but you're somewhere you cannot get a hold of, you might need a power of attorney. You need to schedule that and work with your real estate agent to do that early on in the process versus at the last minute, because there are fees that are associated with getting a power of attorney, as well as if you're not going to be in person, but let's say you're in like New York, you can have a mobile notary. However, mobile notaries, typically there is a fee associated with it, and typically you're going to sign a day or two prior in order to make sure the documents are back. So be very communicative with your agent to make sure that you are there, and that whoever's going to be signing for you, if it's not yourself, that they are all squared away as well. Finally, once those funds are distributed, the house is going to become yours. And that's the best thing, is once all the funds are gone, everyone's approved of it, the house is yours. So here is a little bit more of my information. You can go ahead and scan that QR code to get more contact information for myself. With that, my name is Danielle Fountain. I'm the founder of the One Realty here in Austin, Texas. If you are looking to buy or sell in Austin, please reach out and let's have a conversation. If you're looking to buy or sell and you're outside of Austin, but you need help finding a phenomenal real estate agent, also reach out. I have a network of phenomenal agents, and that we can connect you and get you taken care of, whether it's just one agent or maybe I get you three and that you help to interview to find what is the best fit for you. But with that, I hope you have a wonderful day, and I look forward to hearing from you.